The question was, if you're anticipating a market decline, how do you adjust your investment strategy? And as I will share in a moment, why what I've seen is the most frequent response is almost always wrong and why. But first, as always, my goal is not to tell you what to do, but rather to show you how to think for yourself so that you can build your own success. But again, for whatever reason, you're concerned or anticipating a market decline. And declines can range from a correction to a bear market, a crisis, or a full-on meltdown. So how do you respond? And the traditional approach, and what your advisor will almost always recommend, is stay the course. Stay fully invested. And especially in the case of a market correction, that is almost always the best approach. Yeah, a market correction is defined as a decline of 10 to 20% from the recent highs. Now, you may be thinking, I don't want to have a 10 to 20% decline, but here's the reality. The market will almost always rebound relatively quickly, meaning that if you weren't paying attention, you wouldn't even notice. And the best part is you're staying fully invested, able to participate in future growth. Now, bear markets, crises, and meltdowns are a different story. And we do have an upcoming episode where we're going to just show you some ways to recognize the difference. Now, you can still stay the course. However, where a market correction often rebounds relatively quickly, it takes time to recover from those more severe downturns. And during that time, that recovery period, while you still have your assets, you're not seeing the growth. You have what is often classified as lost years. Now, staying invested is better than doing nothing, but especially later in life as you're approaching retirement, it's much more impactful. So again, what are other responses? Well, the one that I see more and more frequently is people looking for ways to hedge their portfolio, protect it from the downsides. And often those strategies are either unrealistic, they're gimmicks, or just don't fit your situation. And one of the most fundamental things to recognize, there's a profound difference between those with large, substantial portfolios. They're operating on a different agenda and a different approach. And the difference between the novice to the average and middle class investor. And so many of the approaches you will find are either unrealistic or flat out gimmicks. Either unrealistic because they require a degree of sophistication or expense that just aren't appropriate for your portfolio, or they're gimmicks that are distraction that in many cases can hurt you more than they help you. So be very cautious about those kind of approaches. But I said I would share with you what I see the most frequent response is wrong and why. So the most frequent response is the idea of liquidating, going to the sidelines, so to speak, sitting it out with the idea that when the decline happens, I've protected myself, I'll jump back in at a great value, win-win. And it almost never works. And I'll share why. First is markets are incredibly elastic. They can stretch further than you can hold out. You can be absolutely correct with your assessment, with the symptoms, the criteria, but the market has a tendency to stretch well beyond what you would ever expect. I'll give you a great personal example. In 2005, I began saying that the residential real estate market was overdone, overheated, and due for a correction. Now, the response I got, the other side is to always remember there will be counter narratives compelling, seeming to drive you to stay the course. And in 2005 through 2008, while I was increasingly convinced residential real estate was overdone, the narratives were it's different this time, it's different here, etc. However, it took 3 years before the meltdown happened. I started calling it in 2005, but it wasn't until the summer of 2008 till that correction happened. So lesson number one, don't try to time it. You will almost certainly be wrong. If you get it right, frankly, it was pure dumb luck. But there's another factor that even if you got it right, and this is the one where I see so many people fail, is when the downturn happens. The best time to invest is when the news is the worst. I've seen it so often where the opportunity was there, but the news was so scary, people just couldn't take action. And so what happened? By the time the news turned around, the market had already made the bulk of its recovery gains and they completely missed out. So going to cash, liquidating, sitting in the sidelines, almost always is entirely the wrong approach. I would rather see someone ride through it, even if there were some lost years, and still have those quality assets, than wind up sitting on the sideline, because what it tends to do then is reinforce it. And those are worse lost years because now you have no asset, so to speak. Now, there is a nuanced middle approach. And that is, it works well, especially for those who are doing a systematic investment, especially those, say, in a retirement plan where you're contributing on a regular basis. First off, stay the course. You've got that habit. When you stop the habit, it's so much harder to restart it later. Continue to do your systematic investment. Now, but possibly modify it. Continue to contribute to those assets, continue to accumulate more of those assets, but now potentially shift a portion of it into a liquid situation, a liquid opportunity, a money market, whatever it may be, bonds, with the goal that if a downturn happens, it's not a perfect scenario. In a downturn, your investments will lose some value, but you also at the same time have some liquidity to purchase more. Conversely, if you're wrong and the market continues up, that liquidity was a drag on your growth. So it's not a perfect scenario, but it's a nuanced middle approach to give you the opportunity, in the case of a real severe downturn, to maximize it realistically. And I say realistically because what I teach my boys is this. There's a tendency, this desire to get the best returns, the best gains, and it never works that way. What you want to focus on is most reasonable return. Most reasonable return is the most reasonable growth I can get with an acceptable level of risk. And it's coming to that mindset of recognizing I'm willing to give up a little bit of potential growth for that long-term protection. That is, return of your assets is better than return on your assets. But again, most reasonable return needs to be your mindset. It's not trying to make every penny, but rather building a sustainable portfolio that will drive your future success.